Hi, I'm Will Rode. I'm an analyst at Tab Group based in London, and I'm here today with Kay Swinburne MEP for the Conservatives in Wales, and we're at the TradeTech liquidity event. And I thought I'd take the opportunity to ask Kay a couple of questions about the MiFID review that she's been investigating and studying, I think, for about 9 months now. So why don't we start off, Kay, with you telling us a little bit about some of the things you've learned and the work you've been doing.
Well, the Parliament has decided to actually do something called an own initiative report. So we've started early before the formal MiFID review, so that we've actually looked at some of the effects that MiFID has had on the equity market in particular, and actually tried to get the Parliament's knowledge of the equity markets and the markets generally up ahead of that formal process that the Commission will start off in April. So we've already gone through a report. It's been amended by the Parliament, and now we're at the stage of waiting for it to go through plenary, hopefully in the December session. So we've already set some markers in the sand as to where the Parliament, from a political standpoint, thinks the MiFID review should actually head.
Yeah, so you were here today presenting some of your findings to the delegates, and one of the comments that you made in your presentation was that your basic conclusion was that stock markets, the primary service that they could deliver to the real economy was as a capital raising facility. One of the things that made me wonder was, if that's the role of a stock market, what is the purpose of having a multilateral trading platform or having other venues in which to execute trades if the primary service of a stock market is to raise capital for small businesses and service the real economy?
I mean, I think it's oversimplifying it to say that the only role that the stock market actually holds is capital formation. Actually, the whole of the capital movement is obviously very important for business, so that when people actually have a company that they like, that they can invest in it and therefore actually give them the increased market capitalization that they need in order to leverage off that. So I think it's a little too simple to talk about the primary listing. The secondary market actually is really important for capital formation as well, in terms of the market cap of a company, whereby they can leverage upon that to actually raise the funds they need to develop their businesses and expand. So I think the secondary market has a huge role to play, as well as the primary listing, but it's important to get the balance right. I think to get the secondary market working effectively, the role of MiFID was to increase competition so that investors felt more capable of actually transferring their shareholding from one stock to another more easily in a much more competitive environment, which has taken down the costs of doing so. Right. And I think that has actually worked very successfully.
So we're not going to see everything going back to the lit markets and a kind of a regression, which some people seem to pine for.
Well, of course, under MiFID, the lit market actually includes the MTFs. So from that point of view, the lit space is the exchanges as they historically have been in each member state, and of course the new MTFs. So that would comprise the lit space. In terms of the dark space, of course, all the MTFs are now currently operating some dark liquidity, and also the exchanges themselves are offering dark liquidity. And then there's another category in there, which is within the OTC space, you have these new broker crossing networks. Many say they're not new, but what is new is the electronic platform whereby they're crossing their customer orders away from the lit space. And of course, they're not subject to the MiFID rules and regulations on transparency in the same way that the exchanges and the MTFs are, because even on their dark space, they have to use the price waivers that are set up in MiFID. So there does seem to be a slight inequality in the way that a broker crossing network is currently operating versus maybe somebody who's operating dark liquidity on an MTF or an exchange.
So we can expect regulation in dark pools?
I think my preferred solution would be that we recognise broker crossing networks, we recognise the job that they do and the value they add to the investor community when they need to actually execute a block trade. However, at the moment they have no need to be registered, they have no need to be regulated in their own right. They're obviously regulated because most of them are run by broker-dealers, so they're regulated in that way, but not as an entity, as a venue. And I think to recognise them would be a very big step forwards. But of course, that's my personal opinion. The Parliament themselves, when they amended my report, actually requested that they weren't recognised and that there was a move to move all of the trading as much as possible away from the OTC space into the lit venue in the interest of price discovery. So I think there's a slight difference between where I stand and my group stand and that of some other political groups in the Parliament at the moment.
So there was a question towards the end of your presentation from a buy-side representative who was talking about how will shorter timelines on reporting activity in the OTC market, what kind of problems will that, it can give me problems if I'm having my order exposed to the market. And you made a comment about, well, if you're going to build up a position in an illiquid stock, you have to expect some degree of market impact. Can you tell me a little bit about what your thinking is there, especially given some of your thoughts around capital raising and how the equity markets can service the real economy in helping smaller businesses raise funds?
Absolutely, and I think part of the problem here is that we're getting an awful lot of the data we get is always about the big cap stocks, it's about the very liquid stocks, and actually we very rarely get the information from the market participants on those illiquid stocks until it comes for an excuse for them not to be able to report things on a 24-hour basis or a 2-day basis possibly, rather than the 3 to 5 days that they may currently use. And I think we've got a slight difference here. For me, it's important that, yes, we preserve the ability of small capitalized companies to actually be able to function and raise capital, but it's also really, really important that when somebody builds up a position in an illiquid stock, that they take some of that market risk themselves. Okay. And if they're moving that stock price significantly, which they would do if they own 10% of an illiquid stock, then actually is it fair that those people who are trading in the open lit market in the interim number of days are actually completely devoid of that information? And I suspect that that gives a great inequality. And so the price discovery process isn't just the pre-trade transparency, it is made up of the post-trade data too. Mm-hmm. So those two levels of transparency actually contribute to the price discovery. To actually omit that from the market for any length of time, expecting no market impact, is probably a little unfair on those who are transacting in the lit space.
So on the post-trade point, you also talked in your presentation a little bit about an industry-led initiative in terms of consolidated tape going forward, and you mentioned the recent announcement by NYSE Euronext to take this forward, and you also laid down the gauntlet and said unless there is an industry initiative, then expect regulators to act on this space. Why have you singled out the NYSE Euronext initiative as one that is worthwhile pursuing? And can you tell me a little bit about what are your thoughts around the fees that they charge, which I believe a lot of participants believe to be quite high? Mm-hmm.
I think there's two prongs to this. The first is that there's been 3 years since MiFID implementation, and there was an understanding by the Commission that the market would come up with a form of consolidated tape, so that the data would be provided in a form that could be consolidated, and that there would be a market solution to that, rather than a public utility model as they have in the States. So the market was asked to produce this 3 years ago when MiFID was introduced. The reality is we're still waiting, and we are very little distance down the line from where we were previously. And in fact, I think the one thing MiFID has done, some of the earlier speakers today referred to, is that particularly in the UK markets, the quality of data has deteriorated. So actually you've got less of a picture of overall markets and where trading is taking place today than you did before MiFID was introduced. So the market needs a solution. You asked me why not maybe Thomson Reuters or one of the other data providers. The reality is they actually don't provide the consolidated tape right now. Mm-hmm. And they have made very few efforts so far to actually produce one. And in fact, they come and lobby me to tell me that it's not necessary because nobody would purchase it. Now, I have to say, I actually take the opposite stance, particularly in light of the SEC's moves, whereby instead of having ordinary circuit breakers, they're looking at now actually introducing a limit up, limit down stock price. And if they do that, it needs the consolidated tape to actually be able to function. Okay. We don't have the equivalent at the moment in Europe. We need one. We need one for regulators to oversee the market. We also need one if we're going to have sophisticated stops in the marketplace in future that can actually prevent the May 6th type event happening here. So I think it's twofold. We need the data because we need the data, both for regulators and investors, but also we actually need to have a new, more sophisticated tool to actually influence things when the market is in crisis and is suddenly falling. So there is twofolds to this. I would like the market to come forwards with it. NYSE have come forwards with a technology platform that they believe could be used by all other market participants. And they're persuading people that it would be made available to them free, I understand, and that they would work with them as a market solution amongst all participants.
For the delayed data?
For the delay data, it would be free, and to be fair, we wouldn't expect the real-time data to be free. We would expect it to be a reasonable cost, but not free.
Cheaper than what we already see?
I honestly believe that there is a lot of movement in the pricing of the data that's currently being made available.
Okay.
They have now started to unbundle the data, which is a very good first step. However, I think we've got a long way to go before it's a competitive situation. But I think the consolidated tape will actually be an incentive for them to actually get the data there on time and in a good standardised fashion. But actually I think it leaves the door open for the Commission to maybe use a stick in the future in terms of legislation if it doesn't achieve what we want it to achieve.
A carrot and a stick approach.
Absolutely.
Okay. Tell me a little bit about high-frequency trading. I believe that there's been an announcement about the FSA investigating or doing a report into the role of HFT in the market, and there was obviously some news came out of France today about the role of HFT as well, and I believe you're involved in this process. So tell us a little bit about some of your thoughts surrounding high-frequency trading and the role it serves in the marketplace.
My issues at the moment are that we don't have sufficient data in Europe to be able to conclude one way or the other whether or not high-frequency trading provides real quality liquidity to the market, which of course is the claim that any high-frequency trading operation would give right now. The reality is, without that data, I don't think we can draw any conclusions. So I'm fairly disappointed today in Christine Lagarde's announcement with regards to high-frequency trading, because here in the biggest markets in London, we don't have the data to make that assessment. What has happened in the meantime is that the Treasury Department, along with the business unit in the government, they have decided to look at this in a scientific way, which has actually been done by one of the advisors for science to the ministry, which is an interesting concept. A physicist is taking charge of it. He has a number of other physicists looking at the theories behind the market and the new algos that are there, and looking at where the risks may be in the system and whether it's actually good or bad. And until they've run their analyses, I'm not sure anyone's really going to know. But over the next few months, they are actually going to accumulate the data, and hopefully then we'll have a much clearer view by the time the MiFID report comes on the table in April next year.
So you're optimistic on the timelines. The report can come out in time for the MiFID review. Is that your sense?
They will be ongoing. I suspect some of the analyses will actually take place after the original document comes out of the Commission, but actually we have a process of co-decision which takes months to come through anyway, and we amend the documents from a Parliament's perspective and certainly from the Council of Ministers' perspective. So we have quite a long timeline once that report is published from the Commission, and they will feed their information in as they get the information. So they will commission, I understand, some 200 studies over the coming weeks, and when they actually commission those studies, as the results become available, they'll actually introduce those to the marketplace to allow us to be influenced by the data they're collecting.
Okay. Finally, Kay, you mentioned transparency in the fixed income markets, and I believe you've asked perhaps that section of the MiFID review should be carved out from the equity portion because it's a huge undertaking currently in process. Tell us a little bit about your thoughts on what's going to happen on transparency in the fixed income markets, because I think that there's some alarm about what the implications of this measure will be.
The original intention of MiFID, I understand, it predates my time in the Parliament, but was to actually be all financial products. And it took so long to actually get the rules and transparency requirements for the equities markets, which are far more liquid, far more on an electronic format already. It took them so long to actually get to the stage of getting the equities covered by the original MiFID that they actually delayed anything on the fixed income space. Now, I understand that the motive now following G20 claims that all products should be subject to as much transparency as possible, that the MiFID rules on transparency will actually now be transposed across to the fixed income and foreign exchange space. Now, that is the intention. How we do it is going to be critical. For me, each and every asset class is very different, whether we're talking government bonds, corporate bonds, or whether we're talking fixed income. It is all the fixed income spaces and complex products, they're hugely different. So a one-size-fitting-all is going to be a very, very difficult pill to swallow. So I think it needs to be done on a piece-by-piece basis, product-by-product basis. And to take that out will mean that the other parts, the equity review and the derivatives trading component, will not be slowed down by trying to actually implement for the whole fixed income space. So for me, the preferred option would be to split that out, because I think that could take many, many years to get right, and to actually rush it in order to get the rest of it through, I think would be a mistake. So I think we need to actually think very carefully about whether or not splitting them would be a better option.
But currently the plan is to do it all in one go.
The MiFID review covers the whole of the equities review, which is the post-implementation phase, and it also covers trading of derivatives, and it will then cover as well the transparency requirements being transposed onto the fixed income space. So it's a very broad mandate, and somewhere in the middle they're going to put commodities in there as well. So it really is a very broad review, a very, very big piece of work for the Parliament and the Council of Ministers to work on once the Commission has produced their document in April.
Okay, well, with that, I think we'll wrap up there. I'm Will Rode, I'm an analyst at Tab Group. We're here at TradeTech Liquidity with Kay Swinburne MEP for the Conservatives of Wales. Thanks very much for joining me today, Kay.
Welcome.